Hi there, welcome to Neppy Invests. Time to do a quick take video on Medicus. The other day I heard someone mention this was the best company on the ASX, and then other people mentioned that this company's share price is way overvalued. We want to see the share price drop off a lot more before we consider buying. So the question I've got is Medicus overvalued? Now, to get to that answer, I decided to look at their financials going back to 2013. Now, I did pick 2013 for a reason. I'll get into that in a second. So what you want to see with the graph on the left is everything growing. And everything's growing. Revenue's growing, profit's growing, operating cash flow's growing, and of course, market cap's growing. In fact, the market cap in 2013 was 42 million. Now it's 3.3 billion. So you've been a shareholder since 2013 and you haven't sold a single share. You've done very well, so congratulations. But that graph is not what I want to really look at. What I want to look at is the growth rate of all those four things: revenue, profit, operating cash flow, and market cap. And when I look at the growth rates of all those four things, I find something very interesting, which may be proving that those who are in the overvalued camp might be right. And what I'm seeing here is the market cap is growing at a much quicker rate than the operating cash flow, profit, and revenue. So what I've got there on the left-hand side there is the CAGR, is the compound annual growth rate since 2013 of those four metrics. And you can see market cap has been growing at 73% per year. And we compare that to, say, operating cash flow, it's only been growing at 35% per year. So it's almost double the growth rate the market cap has over operating cash flow. And what that suggests to me is that there is potential, only potential, that the market is getting ahead of itself when it's pricing Medicus. Now, that's only potential. There is potential that the market is willing to pay extra for the quality of Medicus, especially when you've got people out there believing that this is the best company on the ASX. So they're more willing to pay extra for quality companies. So what we're seeing here over the last 7 years or so is what I define as multiple expansion. So we're seeing some financial expansion. We're seeing that with the revenue, profit, and operating cash flow growth. That's the financial expansion. But what's really been given a push up the Medicus share price has been multiple expansions. So what do I mean by multiple expansion? Well, it's just saying that it's just looking at the PE and price to sales ratio growth. So if PE and price to sales ratio growth is growing, especially the PE ratio, that's multiple expansion. So if you go back to 2013, the PE ratio of Medicus was 8. That's cheap. And then every single year it's been growing since then. And right now, the PE ratio of Medicus is 144. So that's suggesting the market is thinking or seeing a massive amount of growth ahead for Medicus. Because I see that in the price to sales, it's gone from 3.8 in June 2013 to 54. So the market is paying, we're paying 58 for each dollar of revenue. So that's a lot of revenue, a lot of price you're paying for revenue. In fact, we can actually put a number to the growth rate of the PE ratio in the price of sales. It's growing at over 40% per year. That's fairly significant multiple expansion. So I think what we're seeing in the last 7 years for Medicus, we've seen a financial expansion. We're definitely seeing that, but we're also seeing significant multiple expansion. We're seeing people more willing to pay a little bit extra for Medicus because it is a quality company. Now, in saying all of that, I think, in my opinion, there is potential that we're going to see significant financial expansion in the next 5 years or so. And they're giving some hints in some of the announcements they've been giving us in the last few months. These contracts they've been signing are fairly significant, especially when you consider the margins Medicus have are very high. In fact, the gross margin is something like 99%. So most of these contracts, most of these money, so $40 million, this one with the Intermountain Healthcare, most of that will go to the bottom line. So I think there is potential. We're going to see significant financial expansion in the next 5 years. And that financial expansion could mean instead of multiple expansion, we're going to see the financial expansion take over, and that could justify the share price that we're seeing now. Only potential, but I think for those holders of Pro Medicus, I think the future is looking very bright for the possibility you're going to see those financials of a company just shoot the lights out. Now, when I look at the charts, so I'm always looking at charts. I go back to 2013. I like to look at the history, like to see where I would have bought Pro Medicus if I had a time machine. Anyway, so the most perfect time to buy Pro Medicus was late in 2013 when we saw a bit of a breakout. Share price went above 60 on really high volume. That's one thing I really like to see, and that would have been the perfect time to buy. We had a breakout on high volume, 60 cents or so, and if you held firm for 7 years from when you bought at 60 cents, you've made a mozza. Now, when you look at the 6-month daily chart, this chart looks quite bullish also. So if I was a trader, I'd be liking the look of this. We're seeing some dips, so buy the dips are definitely at play here. We've seen 2 in the last 2 or so months. You could have bought around $30, then $32. The last 2 trading days, we've seen the share price really rocket up based off that last announcement, that $40 million. So that would have been a really good price to buy in around 32 just before this announcement was made. So I wish I was following Pro Medicus a little bit closer. Haven't really been following them closely, and I might have thought about buying them just based off that little dip a few days ago before this announcement. So if I was a holder of Pro Medicus, there's no way I'd be selling out. Because this chart looks quite bullish, and I think there is potential for some significant financial expansion in the next 5 years. Now, if I was not a holder, I probably would just wait and see if there's going to be another dip in the next few months before I might think about buying. In other words, I don't think it is overvalued because I think there's going to be significant financial expansion in the next few years. I could be quite wrong, and if I am wrong, that means some of those people who believe the company is overvalued might be right. But whether it is the best company on the ASX, now a few years ago, someone did mention to me that they thought Essentia was the best company on the ASX, and just look at what Essentia has done since then. This was about 3 years ago. Anyway, I'm not a financial advisor, so if you do need to seek any financial advice, make sure you seek out someone who is qualified. But that's all for today's video. Have a good day and talk to you later. Bye.